Madhav Dhar is with us from Delhi. Madhav, good morning. Great to have you back on the show. Thanks very much. Appreciate it. I just want to start with global markets. It is kind of getting harder and harder to discern what is that one thing which is definitely driving markets. I'm talking about global markets. Take the US non-farm payrolls number, for example. The headline number disappointed. Hourly wages were strong. I mean, each giving bulls and bears, scoring points. But it kind of leaves us nowhere in terms of what to conclusively make of it. What's your sense? Some of the relationships which have worked pretty well, oil and stocks, that also seems to be breaking down a bit. What's going on?
No, I think, we are in a little bit in no man's land in some ways, that the markets have rebounded strongly after a big sell-off that lasted 3-4 months ending in February. So some of those obvious disconnects have ended. The economy looks, sort of a little bit like Goldilocks, looks neither too hot nor too cold. So it's hard to get a directional view on global markets, and let's focus on the US as the key trigger. Meanwhile, since equities are growth assets, a big growth impulse has been China, and the markets corrected when it was clear that China was slumping. And even that now looks like China may be perhaps bottoming out. The real estate data last week was sort of encouraging. We will see some PMI numbers come out in China. It looks like it'll be off the lows. It'll show a little bit of a bounce. So I think markets that way are churning. And I guess you're right. Nothing is obviously cheap, nor is it obviously expensive. The direction of liquidity is sort of uncertain. It was clear that the Fed was hiking, that it was clear that they were panicking, that it was clear that ECB was panicking. Now it looks... So we're in that gray zone in some ways I don't think you'll necessarily see directional clarity, and I think it'll be more of the same till a direction is established. And my own sense is that growth will probably pick up a little bit more and a little bit stronger, starting with China and perhaps with the US and even Europe off its lows. But a lot of that seems priced in. So I think I'm ambivalent about what it means to certainly the OECD markets. So don't know. I think it's a relatively benign environment, except the markets have bounced and the valuations are not particularly cheap. So that gives me some pause and some room for short-term caution, because we've had such a sharp rebound, almost as sharp as the decline we had in December and particularly in January. So let's see how it goes. Not easy, not clear.
Absolutely. Just to take China as an example, one can argue, and I think it broadly is true, that the rebound in global stock markets was also led by China stabilizing, even maybe picking up in the short term a little bit. Commodity prices rebounding, and you've said that one of the best investments could be some of the commodities this year, and you were early on that and right. Oil rebounding and stocks kind of sort of very strongly coupled with these. But, here's some data, Madhav. The Chinese commodities futures trading, the daily value traded for the top 17 contracts in China has now reached $450 billion US. That is 3 times what they have done in the second half of 2015. 3 times. Retail investors essentially appear to dominate trading. Holding periods are very short. And in some cases, prices have gone exponential. Are we kind of sort of, are these numbers well understood? Or are we kind of sort of, setting ourselves up for another steep fall, big fall? And then we look over and say, well, there wasn't any growth. It was all basically speculative activity. And everybody takes a bit of a fall based on what happens in China. Is it possible?
Yeah. It's possible. I think that's a good question and a good observation. And I think there's one thing that you've clearly seen in the last 2 months, which is anytime you have an important bottom, in an asset class that has been going one way for many years, which is what happened to me, and we discussed it in early February in commodities, you will see tremendous volumes, tremendous volumes. So that's not necessarily a sign of bullishness. That's a sign of capitulation, churn, people taking the other side. And I think, the number of contracts is slightly misleading because the value of the contracts have plummeted so much that the overall trading volumes have gone up, probably, but not as much as the number of contracts would indicate. The other thing I would say is, and again, we discussed about it, and I was, I guess, lucky enough to take a position on it, which is that as we discussed before the fact in February, my bullishness on commodities and cyclical assets were not that I saw really a rosy growth scenario out there over the next 2 or 3 years. I just thought that you had a full-blown panic and a valuation disconnect. So there were two things in your favor, at least according to me, that especially the industrial commodity assets, which would be steel, copper, and particularly oil, gold I leave out because it has a different dynamic, were massively oversold and inconsistent with where world growth was. And I think now they're rebounding and getting back to levels that I think are probably fairly valued. Maybe they're still undervalued and they may go further. So I think it's a mistake to see this reaction from extremely oversold levels as a signal of future growth. I certainly don't see it that way. I thought you'd have a 6-month, maybe a 12-month rally of the lows, but the rally, as you say, has been so fast and furious that you wonder whether the whole cycle is truncated. So I'm not quite as, forcefully bullish on these things as I was in early February, just because of the violence of the move back up. But I still think these things are undervalued. I think people are still underestimating global growth, and I think so. You probably have more running room ahead of you, I think. So I'm holding on, and I remain pretty invested. But I have to say, certainly more concerned than I was 2.5 months ago. But that's me. I mean, as you know, I'm very twisted. When people stop worrying, I start worrying.
High thresholds of pain as well, right? Madhav, people look at cross-asset correlations and then they say, well, correlations have broken down. And I hear that very often. Do you believe that these correlations work at extremes?
I don't think so.
Or they very visibly work at extremes? And when, as you say, we're in a no man's land, markets have rallied appropriately and there aren't any triggers. Moves can be very idiosyncratic. They don't have to be, closely correlated with each other.
I think, Prashant, this is my morning to give you non-stop compliments. That's another very good observation. And I think the history of correlations, something I've analyzed in great deal, is that correlations always increase at inflection points, specifically on bear inflection points. So when you have panics, things get correlated. Just because fear tends to be instantaneous, whereas greed tends to be cumulative. So bull market tops or big moves tend to be slightly less correlated, and bear markets or panics tend to be highly correlated. I disagree a little bit in the sense, I don't think all correlations have broken down. I think oil and commodities over the last 12 months are reflecting global growth. And they have been sort of correlated in the sense that oil goes down, commodities go down, oil goes up, commodities go up. And at some point it tips over because lower oil prices are good for equity assets in general up to a point because they're effectively a tax cut. And for more companies, not oil companies, but for the aggregate Nifty or for the aggregate S&P 500, it's additive to earnings when oil collapses. But beyond a point, when you start getting panics, when oil becomes a symptom of global growth, and that symptom shows deep illness emanating from China and infecting the rest of the world, that global growth is slumping, and the poster boy or the emblem of that growth is the price of oil, that beyond a point it becomes very negative. So the price of oil then becomes a proxy for global growth. Equities are growth assets and they get correlated. And that's what we've seen on the way down in the last 6 months and on the way up on the last, I guess, 2.5 months. So in that sense, I think the correlations largely remain. I'm saying starting now, as you observed over the last week, there is some churn, and it's difficult to say what the lead indicator will be. Will it be back to the Fed? Will it be Chinese PMI? Will it be some other policy stuff? Will it be Britain leaving the European Union? I don't know. Remains to be seen. I still think in the end, when things are relatively at non-extreme levels, it's marginal change in growth and marginal change in liquidity that drives equity prices. So I think marginal change in liquidity seems neutral, certainly not positive, but it's at a very low levels and plentiful liquidity. So I don't think that's a negative. And my own gut instinct is the marginal change in growth will probably a bit of a positive. So I think markets are sort of okay. My concern is not so much the environment. My concern is that some of that is again getting priced in. So therein lies the dilemma, especially if you have a value and a contrarian sort of bias. And some of the go-go stuff that was working, like tech, worldwide, has certainly hit a wall. That's something, again, you and I talked about, that it was getting so speculative, especially the internet and e-commerce related stuff, that it had to hit a wall. So that has faded, and money is sloshing around, finding something, speculating in the one oversold, underloved asset, which is commodities. So that's why you're seeing this tremendous churn in commodity contracts, and particularly in China, which is the epicenter of where growth is. And frankly, that's the epicenter of gambling manias. I mean, the Chinese are, ethnically an extremely speculative people. So I think people are trying to see what the next thing is, and people are starting to think a little bit what we talked about. The next thing, at least in the short term, could be commodities, which was unthinkable, in January, unthinkable. But that's the way the investment world works.
Madhav, just taking a small detour, but that made sense, the answer. 43% higher for Thyrocare. I mean, that's a new listing today. This is... it's just huge. I mean, 190 rupees on top of the issue price. The stock's at about 637 now. So they're a diagnostics company. They don't do as many tests as, say, a Dr. Lal PathLabs does. Much smaller in size as well. But the growth rates, and we've got some numbers, five-year CAGR growth rates, sales, operating profits, net profits, etc. And the numbers are, of course, extremely strong. As I said earlier, offer for sale completely. The promoters don't need the money. I spoke with the management last week when the IPO opened, and they basically were very clear that at this point they don't need funding to expand, and they've got enough free cash flows. So this is just purely an exit for private investors. But that despite, I mean, that's a good thing, one would assume. And the second, of course, is the fact that the floating stock in the market isn't that large at all. We'll update these numbers, the P multiples based on the current price, but broadly should be at about now 50 times a year forward earnings. Madhav, you did mention tech a little bit, right? But when you read global market commentary, etc., that seems to be the one space which investors are still hanging on to. Earnings season in the US has come to a close. The clearest winner, of course, is Amazon. That popular acronym, FANG group of stocks, we saw some cracks, but people are still bullish on longer themes, right? Artificial intelligence, virtual reality, self-driving cars, disruption. I mean, these are now concepts which are well understood. I just want your sense on what's happening to Indian tech, which is actually done pretty poorly if you look at the fourth quarter earnings or look at full 16 earnings compared to 15 earnings. Growth rates are dropping off. All the Indian companies also talk about similar things: disruption, virtual reality, artificial intelligence. Is there a basic difference between how we should look at these companies and how some of the US-based large tech giants will do?
Yeah, I think there are two observations rolled into one, and let me try and separate them and address them both, and to the extent I can. I know very little about Thyrocare. I'm watching what's going on, and so I have no insight or input into the IPO, but I think it's symptomatic of something very important that's going on, which is the hunger for growth. That the world effectively has gone X growth, and any area which shows self-sustaining, non-GDP correlated growth will go to a big premium. So that I fundamentally believe that you've had, post the financial crisis, a debt deflation scenario playing out where natural growth, which is demographic and productivity related, is fading, and artificial growth is being pumped by central banks. Wherever there is genuine self-sustaining growth, things will go to a big premium. I think that's exactly what happened in the e-commerce space in India. That's certainly what's happened to the genuine disrupting forces of tech in America, perhaps exemplified by Tesla and exemplified by Amazon. That has nothing to do with GDP. That has something to do with new innovation, change in market share, and creating demand when none existed. If you can do that, you will go to premium pricing. Perhaps that's what ThyroCare is also telling you, that this is a new thing, and it has self-sustaining very high growth. So that will get bid up to crazy levels. So I think that is something that is a very important phenomenon that's happening worldwide, that because growth is scarce, it is artificially created, where it's genuine, that will get a tremendous crowd hovering over it and repricing it. And that, in a funny way, you're seeing in commodities. It gets underpriced, it's going to get repriced very quickly, because it's like, it's there are a lot of people to feed and there's not much meat. So they're going to commodities, they're going to these things. So and when they say there's lots to feed, there's so much money being created, it has to go somewhere. So that's what I think you were seeing in artificial intelligence, you were seeing in Amazon, you're seeing in ThyroCare. So I think that's a philosophical, conceptual phenomena that's playing out, and which has also been my case for India on a relative basis, that there is self-sustaining, non-trade related growth to be had in India as reforms unfold. And I have very little doubt in my mind that India will outperform and go to even more extreme premium pricing, because India will be a growth asset in a growth-starved world. Disruptive tech in the US is a growth asset in a growth-starved world, so is ThyroCare. Coming back to Indian tech, and I think Indian tech that way is a little different. I mean, this may be a bit of a generalization, because at least the older tech that we have, they're basically subcontractors to American tech. That's not where the innovation is taking place. That's not the disruptions taking place. That's not where the patents are. That's not where the branding is. It is effectively whatever you want to call it, labor arbitrage and things like that. So when you see genuine disruption, genuine innovation that is sustainable in India, and you could argue that Dr. Lal Path Labs is a local disruption that is sustainable. And perhaps ThyroCare is piggybacking off the same thing. So those will tend to go to premiums. If and when you have a genuine disruption that is uniquely Indian, you'll see that happening. And, in a slightly different context, perhaps Ola Cab is like that. Perhaps some of the payment systems will be like that. So we'll see. So I think it's a very rational world out there, frankly. I don't think, I think people will premium price sustainable growth where there's a flood of liquidity and absence of old-fashioned industrial growth. So that's I think is effectively what we're seeing.
Lack of alternatives. Madhav, the last we spoke on the 11th of April, you said that financial year 17 earnings, and you've maintained that before as well, 17 earnings should be a lot better than 16. Some 300, 350 odd companies have reported numbers so far. Numbers seem to be upbeat. I mean, obviously the bar has been lowered quarter after quarter. Be that may as it may, but still, numbers are better, especially the consumer names, right? Durables, staples, discretionaries, NBFCs, even private banks for that matter. Some of the bad sectors are yet to report, metal mining, PSU banks, etc. Would you say, I mean, it kind of sort of reinforces what you believe, that earnings are improving at an aggregate level?
I think so. Yeah, I'm definitely encouraged. I mean, I think the key to happiness is to lower your expectations to the point you can exceed them. I think we have done that finally. So I think, I think it reinforces in me the view that we have passed the low of the economic cycle and the past the low of the earnings cycle. And a point I made to you 6 months ago is when you see the economy turn, you will see the multiplier effect. You will see the margin impact on the way up, where you'll have disproportionate earnings growth. Maybe not this year, but following 12 months or 18 months. That if growth picks up just a little bit, you will see a disproportionate impact on EPS. So I still maintain that, and I think inflation will fall more than we think. I think, I hate to rely on the monsoons, but the odds are we're going to have a decent monsoon, and if you have rural incomes picking up, I think you could have a bonanza situation of earnings much higher than people expect. Let's say end of this year, looking forward to the next calendar year. So I think it could be a very good environment, very, very good environment. And as I say, I think you've heard me sound very disappointed in the first year of this administration, where very little reform was actually undertaken, and where it was feebly attempted, it didn't get any head of steam for a variety of reasons. But I think what you're seeing now, just when people sort of giving up on things, is a lot of incremental stuff happening that is not making huge headlines. But if you string together the number of things that at least I see, I think it's very, very constructive, very positive. It doesn't have the soundbite appeal of GST passed or privatization or something like that. But whether it's banking reform that's underway, whether it's the bankruptcy code, whether it's the electronic payment system, whether it's more and more Aadhaar related benefits. I just think there's a whole bunch of incremental things that's happening at a time, most importantly, where inflation is really coming down structurally. And another thing, frankly, that we talked about, the RBI governor was under such attack, I think, 3 years ago, and everybody was saying that, he doesn't get it, we have to cut rates, don't you understand? Inflation interest rates are disconnected in India, it's different here, blah, blah, blah. And I think that the credibility of central banking policies eventually have worked to a point that, to a great extent, inflationary expectations are a function of confidence. So you have restored confidence and respectability in the rupee, in the banking system, its toughness and its independence. And obviously commodities have helped. I think what's happening in food prices and the containing of that has helped. But you will see inflation structurally come down to levels over the next 5-7 years that India has never seen. And as that happens and as growth picks up, I think you will see the resurgence of what I essentially see as a structural bull market that has started in India, let's say starting August 2013, which probably has years to run. So yeah, I remain very upbeat on the incremental reform, its implications for earnings. I think the bottoming out process has happened. I think we are so prone to pyrotechnic headlines, and I just think that will never happen in India. Our political system, our temperament, and our processes that lead to change are so incremental, so glacial, that won't happen. But that doesn't mean that good policy eventually won't happen. That doesn't mean that growth won't happen. I think all of it's underway. So yeah, I'm very encouraged by 4 or 5 or 6 small things that are, I think, adding up to a pretty big thing.
Madhav, it's always a pleasure. Thanks very much for coming in, and we learn something new every time you're on. Thanks very much.